The Precious Metals Week in Review, December 18th, 2015. Brought to you by Precious Metals International. It was a wild week as the U.S. Federal Reserve opted to raise interest rates for the first time in nearly a decade, despite headwinds from a weak global economy. The rate hike was supposed to have been priced in for the stock markets, but after an initial bounce ahead of the announcement on Wednesday, the market sold off on Thursday and Friday. Shortened trading weeks for the next 2 weeks could result in further stock volatility as traders place their final transactions for the year in typically thin markets. The number of Americans filing new claims for state unemployment benefits fell by 11,000 claims last week to a new level of 271,000 claims, not quite erasing the gains from the previous week. The previous week's data remained unrevised, and moves in the 4-week moving average of claims were negligible. We expect U.S. unemployment data to remain volatile throughout the early portion of the new year, as it typically does due to the holidays. The U.S. Federal Reserve held its final Federal Open Market Committee (FOMC) meeting of 2015 this week, and opted to fly in the face of nearly every other central bank around the globe and begin raising interest rates off near zero, where they've been since 2008. The day after the FOMC meeting concluded, a report from the U.S. Commerce Department indicated that a stronger dollar continued to weigh on exports for the U.S., and additional gains in the dollar after the Fed's decision could create even further drag on the U.S. economy as exports to other countries become even more expensive. Late Friday, the U.S. Congress passed a $1.14 trillion spending bill, which saw a last-minute addition of language on Tuesday, which will remove the decades-old ban on exporting crude oil out of the U.S. The bipartisan bill will now go to President Obama's desk for his signature, and he is widely expected to sign off on the measure. The move smoothed the way for a peaceful end to the year without threats of yet another government shutdown in the U.S., but the implications that lifting the export ban will have on the price of oil remain uncertain. In a working paper that was published on Wednesday, the People's Bank of China predicted that annual economic growth in China is likely to slow further in 2016, falling to 6.8%. The research paper comes on the heels of a warning by ratings agency Fitch that a shock scenario in China's GDP could trigger rapid contraction on global growth. Fitch said that lower for longer in terms of growth, interest rates, and commodity prices could be the defining mantra of this decade for the major advanced economies if a Chinese shock scenario materializes. Fitch was quick to note that its scenario factoring in a shock decline in China's economic growth was purely hypothetical and was designed to test credit connections between China and the rest of the world. On Wednesday, President Obama's administration formally notified Congress that it had authorized an arms sale package for Taiwan worth $1.83 billion. The sale will be the first such sale of military hardware to Taiwan to take place in over 4 years and was apparently approved by Congress nearly a year ago. China, of course, strongly condemned the sale as it considers Taiwan to be essentially nothing more than a renegade province. The move is likely to result in further rhetoric between the U.S. and China over the growing militarization of the South China Sea. In Europe, leaders were set to meet in Brussels beginning Thursday to discuss the United Kingdom's demands for reforms ahead of a planned referendum by the end of 2017 on whether the UK will remain in the European Union. Donald Tusk, president of the European Council, said in a statement released earlier in the week, "During dinner, we will discuss the UK issue to see if we can pave the way for an agreement in February. As I set out in my letter, we have achieved significant progress in negotiations. However, we are still far from an agreement on several topics." The UK's referendum could be held any time between mid-2016 and the end of 2017. According to a Lord Ashcroft poll of 20,000 voters that was published on Wednesday, if the referendum were held today, 47% would vote to leave the EU, with the remaining voters broken up into 38% who would choose to remain and 14% who were still undecided. U.S. crude oil prices remained weak below $36 a barrel as supply excesses continued to weigh on the market. The continued rout in oil prices is raising concerns that some banks may soon be facing heavy pressure from loans made to the energy sector during the boom time, which could potentially become non-performing with a risk of default. The euro began the week moving slightly higher against the US dollar until the start of the FOMC meeting by the US Federal Reserve on Tuesday. Shortly after the meeting began, the euro moved lower and then sideways through the end of the meeting on Wednesday. There was a brief spike back to near even immediately after the announcement that the Fed was indeed following through on its plan to raise interest rates, but the spike was short-lived and the euro moved downward against the dollar for the rest of the week and will close the week lower. The Japanese yen began the week much as the euro did, with a brief spike higher against the dollar. From there, the yen moved steadily lower through the week until news broke Friday that the Bank of Japan would be increasing its annual purchases of ETFs by 300 billion yen. The yen bounced after the BOJ's announcement, but could not recover fully and still appears set to close the week slightly lower against the US. The Federal Reserve and its move to finally raise interest rates was seemingly the sole focus of news outlets this week. In a commentary piece posted to CNBC's website, Dr. Michael Ivanovich, an independent analyst who focuses on world economy, geopolitics, and investment strategy, noted that as the world focuses on the effect of a mere 0.25% rate hike by the Fed, the larger problems present in the world appear to be getting pushed aside. Dr. Ivanovich's piece is quite a long read, but is definitely worth the time and gives a fantastic overview of the bigger picture going on in a Fed-focused world. You can find Dr. Ivanovich's commentary on CNBC's website by clicking the article title, Focus is on Fed, but Europe Politics and Chaos, Asia Tensions High, in the online version of our memo. The final 2 weeks of 2015 are upon us, and the timing of Christmas and the New Year will result in 2 back-to-back shortened trading weeks as markets will close early on Thursday and remain closed on Friday during both weeks. Mainstream media usually has a habit of lightening up on its coverage during the final weeks of the year, and many traders likely will be leaving for vacations as well, so both news and trading volume may be light for the next 2 weeks. During such periods of scarce news, it remains vitally important to seek out any information that could have an effect on the price of precious metals as we enter 2016. The Federal Reserve's decision to raise interest rates by a 0.25 point this week was followed up by a news conference at which Fed Chair Janet Yellen took extra pains to point out that any further rate moves from here would likely be at an extraordinarily slow pace. Ms. Yellen also pointed out that the Fed remains data-dependent, which could mean that even this week's minuscule rate hike could be reversed if the U.S. economy shows signs of backsliding and further weakening. The media, having lost their favorite topic of whether or not the Fed will hike rates, has now seized on the phrase lower for longer as their next candidate phrase for extreme overuse. Much of the media's focus in the near term will now likely shift to the continued decline in the price of oil and the ongoing economic contraction that appears to be accelerating in China. In addition to these key points, both of which have a direct impact on the global economy, we must also pay attention to events in both Europe and the Middle East. The ongoing civil war in Syria and the spread of the Islamic State are both placing severe drains on the already strained economies of Europe, Russia, and even the US as defense spending skyrockets. According to the Russian news agency TASS, Russia has made plans for purchasing an annual 70 to 100 planes and more than 120 helicopters and up to 30 surface ships, submarines, and special and auxiliary ships and 600 armored vehicles a year to modernize its military, despite ongoing economic difficulties brought about by the sanctions it still suffers under due to its actions in the Crimean Peninsula and Ukraine. China also appears to be ramping up its own military budgets And an increase in military spending was also present in the U.S. spending bill, which passed in Congress on Friday. The recent terror attacks by Islamic State sympathizers in both France and the U.S. has also resulted in a growing backlash against the migration of those refugees fleeing the conflicts in Syria and Iraq. Some of the attackers in France apparently came into Europe under the guise of refugees from the raging conflicts. As we begin to close out 2015, avoid the complacency that seems to seize the markets during this time of year and remain vigilant in monitoring global news outlets. Investors who are unprepared to act if global events trigger a sudden and rapid rise in precious metals prices once more could miss what might turn out to be an incredible buying opportunity with prices at their current levels. Remember that precious metals should always be viewed as a long-term investment, and that the key to profitability through the ownership of physical precious metals is to actually acquire and own the physical products and to hold them for the long term. Always remember that you should never overextend your ability to maintain ownership of your precious metals over the long term. The Precious Metals Week in Review, December 18th, 2015. Brought to you by Precious Metals International.